Hello and welcome back to the Troutman Pepper Lock Battery and Storage Podcast. Today I am joined by my co-host and firm partner, Casey Bell, who works out of the firm's Austin, Texas office. And our guest today also comes from the state of Texas, OCI Energy's president, Sabah Bayatli. Thanks for coming on the program today. Let's start first with you, Casey. If you could give us a quick introduction to your practice.
Thanks, Bill. As Bill said, my name is Casey Bell, and I'm a partner in the Austin office of Troutman Pepper Lock. I joined the firm back in May of this year. I've been working with several of the energy transactional group partners at the firm over the last several years with respect to local energy regulatory due diligence for a myriad of different renewable energy projects that the firm's clients have been developing and financing in the ERCOT space. That's where my background is in ERCOT, as well as dealing with energy utilities who are regulated by the Public Utility Commission of Texas. And I continue to do that same work as part of the energy regulatory group at the firm, helping folks with renewable energy projects coming online in the ERCOT space, and more so lately, energy storage projects, which seem to be part of the larger growth part of ERCOT in the last few years. And so that's a bit about my background.
Thanks, Casey. And Sabah, you are the president of OCI Energy. As I said, please tell us a little bit about your career journey. And if you could give us a quick overview of OCI Energy.
Happy to do so. First of all, thanks for the invite. It's wonderful to be here. About myself, Sabah Bayatli, president for OCI Energy. I joined the company in 2013. Boots on the ground engineer, grew up to be basically the president of the company now. We do development. OCI Energy is a developer and IPP for solar and battery energy storage projects in the US. We are headquartered in San Antonio. We were established in 2012 by our parent company. We are subsidiary. We roll out all the way to South Korea. Our parent company is OCI Holding. It's actually a South Korean conglomerate, publicly traded in South Korea. They have multiple businesses worldwide. One of their major businesses is polysilicon provider. For people who are not familiar with the polysilicon, it's the raw material to the solar panels. They have factories in Malaysia. They have factories in Korea. I believe they are entering into a new business opportunities around the supply chain for solar as well in Vietnam. But back to OCI Energy, again, we are developers and IPP for solar and battery energy storage system. We do organic development and we do inorganic developments. Organically, we are very active in the southern states, take it all the way from Oklahoma, Texas to Georgia, Tennessee. And inorganically, we are active across the US market. We are looking for opportunities basically to JV with other developers, either acquire early stage projects from them or JV that opportunity with them. We are also started penetrating the Canadian market in certain states from Canada. That's in a nutshell about OCI Energy.
Thanks, Sabah. That's a great introduction, and sounds like there are a number of projects that your company's already developed in the solar space, and now you're wading more heavily into the storage space. So a lot of activity going on. And maybe this is a question for both you and Casey, but maybe just dive a little bit into what it's like doing business within the ERCOT region of Texas.
Yes, from a development perspective, Texas has been our backyard. We were established in Texas. Most of the projects we developed so far, I would say, in the state of Texas, within ERCOT market specifically. But today we are very active in different markets. What distinguishes Texas or ERCOT specifically from other markets in the US, I would say the interconnection process in ERCOT is very different from interconnection process elsewhere in the US. The US power market is complicated because you have to understand the dynamics in every single power market. Is it regulated market? Is it deregulated market? If it's deregulated market, then within which market you are operating on? What is the interconnection process? What's the power market dynamics process in that market? But going back, what distinguish ERCOT, differentiate ERCOT from other deregulated markets in the US, I would say it's the simplicity around the interconnection process and the design for the interconnection. I think that's what helped Texas to be Texas today in terms of having the most penetration of wind and solar and storage, frankly. If you compare the 50 states today, which state has the most wind, solar, and storage combined, you will find out the state of Texas has the most, and by far the most. And the only driver there is really the simplicity for the interconnection process. It has downsides, surely, but the upsides is there. And as conclusion, as a result, basically you can see the upside is working because the penetration is very high. I think that's what would differentiate Texas from elsewhere in the US.
Thanks for that, Sabah. Do you see the interconnection process and the simplicity of it in ERCOT to be a benefit going forward into the future for continued investment in energy storage projects in that space?
In short, the answer is yes. For the storage specifically, if you think about the storage, the battery storage is, I call it the byproduct of high penetration of wind and solar, right? So for any market to see a need for storage, that market first need a high penetration of solar and wind. Once you have a high penetration of solar and wind, then you create this opportunity in that market for the storage. That's exactly what's happening in Texas. So the more penetration of solar and wind we will see, we already have a huge penetration today. I think we have in the state of Texas, in operation, we have close to 70 gigawatt, probably combined of solar and wind. Don't quote me about the specific number, but it should be very close to that number, I believe, today, which means there is a strong opportunity for storage. And with the growth path, what ERCOT themselves are forecasting today, basically, we are expecting much more generation sources to be penetrating this market. Therefore, yes, you will create more storage opportunities. And with the simplicity around the interconnection process, I think that will definitely help to get more storage to this market.
So where does OCI see things going from here in the ERCOT market for energy storage projects? And specifically, I'm thinking about from the side of revenue. Where do you see the opportunities for the grid scale energy storage projects? And what are some of the challenges that you all are predicting will need to be addressed and overcome moving forward?
That's a really great question, right? In the US, there is two types of markets for the storage. The ERCOT market, which I would call it's a spread market. That's why you have seen a lot of merchant assets so far, where basically trying to monitor or trying to capitalize on the spread between day and night on the energy pricing, charge when it's slow, sell when it's high. That's basically the business plan for the majority of the energy storage projects we have in Texas today. In California type market, you are driven by certain cash flows. So your business model is different because the state has certain mandate by certain years. Therefore, that mandate flows to the utility. Utility have to procure and they have to enter into certain contracts. So it helps you from the financing perspective when you finance these projects by having more certain cash flows. Going back to answer your question, ERCOT, we have seen a lot of merchants so far. We are expecting the market to still strong in merchant, although it will depend on certain areas in Texas, right? Because the nature of merchant market, again, it depends on the spread of the pricing for that node. But also we are expecting more toll agreement to be probably coming to the market in Texas. You will see utilities will need basically to balance their own portfolios too. So I would expect more utilities basically to see the need for certain storage in their portfolios. And usually the way the utilities procure them, they procure them through storage capacity agreements, aka toll agreements. But I still expect the majority of the market in ERCOT to be merchant at this point. That's my personal opinion.
Thank you for that. And as far as the contracted assets, as you just mentioned, there's been some activity from OCI recently in that space, correct? With a relatively large energy storage project in the San Antonio market?
Correct. And that's public information. It's available. We have entered into storage capacity agreement for our project called Alamo City. It's located in Bexar County in San Antonio. It is 120 megawatt 4-hour system that reflects to 480 megawatt hour system. We entered into that agreement with CPS Energy. I'm blanking on the exact date here, but I believe earlier, probably this year.
I have a question about the storage. When you look at these opportunities in Texas, are they typically for a 4-hour battery or a 2-hour battery or longer, or is it just a mix?
What you see in ERCOT, generally speaking, is merchant. When you financially model the merchant assets today, you will realize probably 1 hour is enough. Basically, when you do the spread. Again, it's a merchant pricing, right? So you have your financial model, it's an Excel file, you enter your cash flow projections for the next 10, 15, 20 years, whatever the business model is. And based on that spread of the pricing, that's create your revenue. And based on that revenue and based on how long you have the spreads in the pricing, you optimize and you find the sizing, how long should be. So far, what we have seen in ERCOT is 1 hour, maybe 2 hours. Like that would be the range. The market usually talks about 4 hours because I think it's coming from California. California mandate require 4 hours. That's what the state is. Otherwise, you will not be able to get those contracted cash flows through utilities. But back to the state of Texas, I would say free market storage here so far have been, I would say, anywhere between 1 hour to 2 hours on average. We are seeing, again, this is the market dynamics because it depends on how the load and the generation profile will look like over the next 5-10 years. If you are a utility, how you are estimating your portfolio to look like. And based on this, you will procure it. Sometimes could be 2 hours, could be 4 hours, probably what you need to balance your own portfolio.
You mentioned what that load profile will look like. And I think you probably know that in ERCOT, some folks are forecasting some pretty incredible increases of load in the next 5 to 10 years based on data center development, advances in AI. How does OCI view that load growth potential, and how is it positioning itself for success with its future energy storage projects in the face of that potential?
To a developer for solar and battery storage projects like OCI, this is great news because we are saying basically the demand will increase and will increase strongly. And this is the power market demand. So we are looking forward to it. We know it will be challenging. And frankly, I have seen it in other podcasts in the past and I see it now. I say it now again, I think we need every single generator to come online as soon as possible to be able to feed this amount of demand coming over the next 5 to 6 years, right? And mostly driven by the AI and data centers. So we see it as an opportunity. In short, it's a big opportunity. It's a big opportunity for solar developers. It's a big opportunity for wind and gas developers. It's a big opportunity, therefore, for storage guys as well. Because the more solar, the more wind you have in certain grid, again, you are creating that need for battery energy storage systems. So we see it as a good opportunity.
To that point, are you seeing inquiries about hybrid projects where you'd pair the solar and storage together at the same co-location?
You could. We are seeing, again, there is people probably scratching the surface around these ideas because eventually what the data center, if you're trying to co-locate, I'm assuming the question is if you would like to co-locate them for the sake of data center demand or just like co-locate them just as a solar and storage.
Yeah, no, I throw the term co-location around. It could mean either, right? But I was really thinking more of co-located storage and solar. I also understand that there's a huge interest among the data center developers of having on-site generation. So there's co-location in that scenario as well. And the advantage of the storage, right, is it's a smaller footprint. So you can put the storage resource next to the data center. But in either scenario, there's the use of co-location. I was more curious about the solar and storage, but I can see how it's a hot topic right now for data centers as well.
And we can address both, right? So on the solar and storage co-location, I think that idea made a lot of sense in Texas and everywhere in the US as well before the Inflation Reduction Act, before 2022, because at that time, for you to get the tax credit benefit for the battery storage, you had to co-locate it with solar. There was certain boxes you need to check from the tax perspective to make sure that you are really co-locating them and you get the benefit for the batteries as well. You extend the benefit to the batteries as well. If they are behind the meter, there was certain parameters around it. After the Inflation Reduction Act, we really did not see a lot of benefits for co-locating solar and storage anymore. And frankly, it is complicated to co-locate them, not technically. I think we think from capital perspective, it's a bit complicated because the capital that is seeking solar ownership, it is not the same capital that is seeking merchant storage in ERCOT, right? Completely different capital profile, completely different risk profile for these assets, right? The merchant storage has high return, but high risk exposure on the cash flows. Most of the solar we have seen is contracted solar. So you have an offtake yeah, probably you are not covering 100% of your generation, but you have a good offtake. It goes for probably 15, 12, 18 years. And based on that contracted cash flows, you are raising financing, you are raising debts and everything else. So from day one, we knew about it. It's actually complicated to find the same house that is willing to take those two assets in the meantime. So co-location in our mind was kind of like hard to get before the Inflation Reduction Act. But after the Inflation Reduction Act in 2022, we just saw there is no need for co-locating them. Yeah, we can put them physically in the same place. They're close to each other, but literally black and white, we separate them to two different projects. They have nothing to do with each other. The storage, to your point, take very small space in your big solar farm area, right? So no brainer, you can develop it. But while we are developing it, we took decision in 2022 actually to have a black and white walls between them, because we are sure, and we have seen it, that capital is seeking the ownership for their assets, or these two assets are actually different assets. That's on the co-development for solar and storage. What we are seeing today is data center. You can probably think about co-locating solar and storage to feed a data center load that you could have on site. That could be an opportunity. People are thinking about solar and storage versus solar and gas, actually, to feed the data center. And the reason people are thinking about solar and storage versus solar and gas, it's about cost, right? So the storage, yes, you can put a storage that is 1 gigawatt capacity, but for how long? How much is enough for the data center load? Is it 2 hours? Is it 4 hours? Is it 10 hours? Is it 24 hours, right? And the more you go on the duration, the higher cost you will have versus this different scenario on the gas side. So these two scenarios are being explored as we speak in the market.
That's interesting. You talked a little bit, Sabah, about the contracted assets versus the merchant energy arbitrage for battery storage projects in ERCOT, and seemed to think that the trend was going to stick more to the energy arbitrage side. What about the size and the geographic location for energy storage projects? OCI focusing more on these larger projects like the Alamo City energy storage system, or also on distribution level battery projects of less than 10 megawatt?
I would say for us, we are a utility scale developer. The small project we developed today is probably 100 megawatt on our end. The way we size our project, we'd like to size them around 200 megawatt AC. Like that's the capacity. In terms of duration, we design our sites to take up to 4 hours minimum. So the good news in the duration, you don't need to decide on them at day one. So you could have the flexibility to decide on the duration later time in the process. But in terms of capacity, we would like to size them around 200 megawatt. We think that's a sweet spot for the market. Again, from financing perspective, that's probably enough risk for a project from ownership perspective. You want to diversify your storage because this is our merchant. These are spread-based in ERCOT. General of thumb, you would like to get close to the load, but sometimes actually you see the spread in areas that you are not even close to a load, right? So you are see them in completely different areas. The people who do merchant storage, they understand this. The spread is a risk. Again, it's high return, high risk business. So because you could have an area in certain market in ERCOT where the spread is so nice today, but ERCOT a month, 6 months, 1 year from today, they could come with upgrade in that area that can change the dynamic around your spread, right? That can question the entire business model you have for that storage. Therefore, you really don't, as a storage owner, eventually, if you are an IPP for merchant storage, I would say you want to diversify. You want to have assets across the board in different locations. In this way, you are diversifying your risk in terms of the spread in the storage.
And is OCI also seeking diversification with respect to its projects that are sort of the pre-NTP development versus projects that OCI is actually seeing all the way through to commercial operation and actually continuing to own and operate and manage those assets itself or through a third-party optimizer?
It's a really great question. I always answer to say, we are developers. We are in the business of recycling capital. So we are, and that's truly it. But what we do as OCI, to answer your question, I think it's a lateral. We develop projects to sell the projects. Some of the projects, we sell them at the development completion. Some people call them shovel-ready. Some people call them pre-NTP. Most of the projects we have developed over the past 5 years, we sold them at that project. Now, we keep some of these projects for our own because we have our IPP wing as well. That's Alamo City, as it's a prime example of that. We are working on another solar farm in the Houston zone right now to own and operate and keep under our belt as an IPP. So it's actually, the answer is both, but it's case by case. It's truly case by case. It depends on our capital position at that time for that project. And based on that, we'll decide to, should we sell this asset or should we keep this asset in-house? That's usually how we make our decision.
And in terms of diversification, also geographically, what regions are you looking at beyond Texas? And you maybe talk about your MISO experience a little bit.
We are very active already today in Texas, Louisiana, Mississippi, Tennessee, Georgia, Colorado, Oklahoma, like across different markets, I would say. And frankly speaking, number one, what matters to us is diversification. We have to diversify our pipeline. We are big in Texas. We have a lot of projects in Texas, but beyond that, we are penetrating other markets as well. First, to grow, but second, to diversify too. Now, the challenge you are having in other markets is, frankly speaking, is a single word: interconnection. Interconnection is just not moving. And that's why, again, that's why you see ERCOT is going so fast in terms of penetration, is able to attract those big data center and AI because the generation is able to come online. Therefore, you are bringing the customer the load to come to this market. Other markets are struggling, especially the deregulated market. In the US, there are 7 deregulated markets. One of them is ERCOT. There's the other big ones, PJM, MISO, SPP, right? Frankly, it's hard to move a project there, right? So if we have example from, I say that like loudly today, I think it's MISO or other markets, they are still working on their 2021 or 2020 projects, right? I think recently they finalized 2020 and they are moving to 2021. It's kind of like Apple is still working on their iPhone 2021. That's basically what it means, right? So they are yet to release their cluster from 2021. People applied to their interconnection cluster in 2021. People are still waiting for that study to be finished. With that pace, there is no way we can get AI to that market. It's just because it's not coming, that the generation is not coming. And I think it is because of the way the market is designed in this market. So the way the market is designed in every market except ERCOT today, it is where theoretically it makes a lot of sense to developer. In theory, on paper, it makes a lot of sense. And because what it does is it basically tries to tell the developer, by the time you come online, we will make sure that you have as less congestion and curtailment as possible. At super high level, when you zoom out to that policy, that's really what it means. Practically, it's not working because it is so perfect that you are not able to move on in the process from this stage to this stage, because every time you move from phase 1 studies to phase 2 studies, you send those estimates to 200 developers, 300 developers who have Gen in your queue, and you are giving them different cost profiles because you assumed everybody's coming online, and you scare away, people will drop, you have to redo your study, and you have the same issue. I'm describing 2021. And by that time, you have to solve 2022 and 2020. It gets this chicken and egg problem that they are not able to solve. That's why we are not getting these new versions of the clusters, right, yet. So that's the circle they are living in. And that's why you don't see a huge penetration of generation inside these markets. It's working, yes. We have projects in SPP. We have projects in MISO today. Frankly, you will not see the speed that you are seeing in ERCOT.
And so ERCOT, the process there, some people call it connect and manage, right? And it's sort of a deal where you'll get connected much quicker and then they sort of plan behind the connections, right? And that helps in terms of getting the generation online faster. Potentially that creates problems in the future transmission wise. Does OCI see things changing with respect to the interconnection process in ERCOT? Or are you guys all thinking that we're going to see the same process moving forward and it's still a profitable area for us to continue investing?
We are not expecting change on ERCOT in the gen side for solar, storage, wind, gas. I think because the process already has been successful. And again, when you look into ERCOT and how much penetration of generation you have inside, that's basically a testimony to the process. It's working. And that's driven by Senate Bill 6 earlier this year. I think we're expecting some tweaks to the load side. I think it's mainly driven, frankly, by the data center load. I think they are trying to push for process for the data center as well. I would say probably they're trying to make it similar to the gen side too. They will see some challenge, and we are tracking that end. But I think that will help the market to have more transparency, to understand what is coming. I think that will be helping. It could have some upsides and downside to the market. I don't understand exactly how, but I think the more transparency will help the market. And you're right. What happened? The difference between ERCOT and MISO in this example, I'm giving MISO as example, but it's really a similar story to SPP and PJM. I gave always this example. Think about a brand new neighborhood in your city. I don't know where are you guys living, but just think about that city. Think about brand new neighborhood when you are opening like a new highway that will serve 10 communities. Those 10 communities have 10 real estate developers are applying basically to the city saying, developer one will say, I have 500 houses on the street. Developer two will say, I have 200 houses on the street. And everybody will apply to the city saying, we are coming. The way it works in ERCOT say, you come online, give me your application, go ahead and come. And we will build this road for you, or this road is already there, we'll serve you. You come online, you bring all these people to live in these communities. Once you have traffic, too much traffic and congestion, we will do our economic testing to see if it makes sense to widen that street for you. And if it does, then we'll go and widen it and we'll solve your problem. That's how ERCOT works. The way MISO works is like, it tells the developer, no, don't build anything. Let me make sure I tell you how much it will cost you, right? And you have 10 developers, and developer toward this chicken and egg problem. And they try to give every developer an estimate for how much it will cost them. And they give like a huge estimate to every developer because everybody's trying to come online. But after that, developer number 6, developer number 7, probably they drop because of some reason. And now they have to do the math and they have to come with a new estimate. And it's coming this chicken and egg problem they are not able to solve. That's what's happening in ERCOT versus in MISO.
That is really interesting to hear from somebody in the trenches trying to develop these projects. And it's a message that I think FERC and policymakers need to hear and understand. I had one other question about the difference between the ERCOT market and the other markets. And that is ERCOT, we always think of it as an energy-only market, whereas you think of some of the other RTOs as having a capacity and energy component. PJM's had a lot of controversy about their capacity market. MISO's or California's, they call it a resource adequacy construct. So when you're, as a developer, looking at these different markets, how does that play into it, thinking about the different revenue streams? If you develop a project in MISO, you'll have a resource adequacy stream and an energy stream. If you're developing in Texas, it's just the energy. How does that play into your decision making?
I would say from the development perspective, at day one, when you try to develop across different markets, frankly speaking, you are less worried about how the revenue will look like. You are worried about, let me get this through the development process. Let me get this through the interconnection process. Eventually, this market is sold market. Take PJM, take MISO, take SPP as example. It has its own, basically, in ERCOT, you have your energy, maybe for solar only. That's your component for the revenue, right? The megawatt hour. In other markets, you could have two different. You have the capacity market will have some revenue for you, and you will have the energy will bring some revenue for you. But development focus at day one is like how we can pass those hurdles even to go to that stage, right? So any projects you have today is fully developed in MISO, in PJM, and SPP. Frankly, if it's solar, I think it will go with a premium as a developer. It will go with a premium because you passed all this like long waiting time for these markets. And once you are at that stage, I think we will find out that you will have probably a good off-taker waiting for me to find, basically, to sync it with that project and move on. So at day one, when you try to develop it, you are really less worried about the cash flow because these markets are proving themselves. Big market, liquid market. Yes, they are a bit more complicated than ERCOT. It's not only energy, it has the capacity portion. But there is a lot of other solar and wind and a different generation have been online there for a long time. So your focus is like how we can get into that late stage development, if that makes sense.
Well, that in and of itself is fascinating because I did not appreciate that. And so what you're coming back to is that the interconnection queue issues, those are the issues. Those are the sort of elephant in the room issues. I mean, that's a pretty profound statement because what I've always thought about is, the developer, they're going to be hyper-focused on, how do we make money in this market? But it sounds like what you're saying is something different, which is basically we're fairly confident we can make money in any of these markets, but our challenge is how do we get through the queue to enter the market?
That's 100% true. Because on the offtake side, once you arrive to that late stage of development, as long as you have the interconnection figured and you don't have $200 million bill to build a substation for you, right? Which kill your project economics, as long as you are staying like within certain parameters that you are able to absorb as part of your cost, then basically the offtake side is very liquid in these big markets, right? Again, I'm describing the big 7 deregulated market in the US, right? So the regulated market has its own dynamics, but like if you're talking about SPP, PJM, MISO, these are like very liquid markets on the offtake. The good and bad things about the liquid market is like the price for the PPA is kind of like, that's the range. It's not like I can ask for this or this. I'm within the range, right? But the question is my project cost is able to meet this PPA expectations, the offtake expectations? And usually the answer should be yes, as long as your interconnection cost is not astronomical, right? That's the problem. And that's the problem with these markets.
Wow. That's worth the price of admission right there for people who are listening to this. That is a really interesting insight, and we thank you for that.
Sabah, we talked a lot about ERCOT and about how the interconnection queue is beneficial to getting projects interconnected quickly and into the market. What are y'all's thoughts on whether or not there's been saturation in the market? I was just looking at some of the statistics, and there's been a record over the last 2 quarters for the number of megawatts of new battery storage projects that have come online, while at the same time, it seems as though the revenues overall have flattened out or even maybe declined some, perhaps due to market saturation, especially with respect to ancillary services. What's OCI's view on how developers and owners and operators of battery storage projects will adapt and adjust to those factors? Or do you think the market's growing fast enough to accommodate all of the massive amount of energy storage projects that are in the queue and set to come online in the next 4 to 5 years?
I'll answer your questions in 2 areas. One of them on the queue side, saturation. As a developer, we have been saying this, there's saturation in this market on solar and storage probably since 2015, right? They always say there's saturation on the queue. I think it comes down to you as a developer. Do you really know what you are doing? Like why you are developing this project in this area? What's the story behind it? What's your diversification strategy? Because as a developer, you have the risk of you develop multiple projects. Some of these projects could be bad apples eventually by the time you arrive to that late stage. It's not like every project it will be great apple, right? So that depends on your judgments as a developer, how many projects you have. So I would say not every project I have in the queue today in my own mind as a developer is a really great project. We could have a lot of bad projects in the queue, and that's something we understand completely as a developer. We understand how this business works, right? So that's from a queue perspective. So yes, it comes across as like there is saturation on the queue. There is a lot of projects, but frankly speaking, I don't know if there is a lot of these projects that they have certain strategy in terms of market penetration. This is applicable to solar. It's applicable to wind, gas, storage as well, by the way. So that's on the queue side. On the market side, you are right. I think a lot of people who own merchant storage today, probably they were disappointed in 2024 and probably continuing in 2025 as well. But guess what? That's the profile of merchant storage, right? So you could have a year when you are low, and you could have a year in 2026 when the market is so high, right? So I don't think as a merchant, and having said that, I don't have a merchant storage under my belt as of today. I should clarify that, right? But I would imagine, because we are very familiar with the financial models for those merchant assets, it's hard for you to say, we will have this revenue fixed like this for the next 10, 15 years. That's impossible, right? But you will have ups and downs, and probably 2024 and 2025, what's the down for you? But 2026, 2027 could be the up for you. 2028 could be another down, right? But overall, I think you look into the next 15, 20 years and you say, how much on average we made over a year? That's how the merchant really asset works.
Thank you for that. It's really, again, interesting. And I feel like I've learned a lot today. I feel like I have to be the bad guy here and say, I think we've come to the end of our time. I think we kept you longer than we normally do our guests, but we really appreciate you coming on our program and sharing the insights so frankly and so expansively as you did. Really appreciate that. And Casey, my co-host today, thank you for joining us and joining the program. And I'll let you fellas give your final thoughts.
Thank you so much. Thanks for the invite. We are happy to share our thoughts on the market. Again, we are seeing amazing growth here. There's opportunity for everyone. Frankly, I have seen it earlier this year, and I say it again. I think we need every single generator to come online as soon as possible, right? Because if we do believe in the data center and the electrification and this coming load, we have to supply it, basically, I think, and we need everyone's help to make it. So we are here to give our opinions. We are hoping basically people will take it and will help at least to make certain markets more efficient. We have huge markets in the US, and we need to basically improve the process to be able to get more generation online. Therefore, we create more demand for these markets.
Sabah, thanks so much for being with us. I appreciate it.
Likewise.
All right. Thanks, everyone, for listening.
Copyright Troutman Pepperlock, LLP. These recorded materials are designed for educational purposes only. This podcast is not legal advice and does not create an attorney-client relationship. The views and opinions expressed in this podcast are solely those of the individual participants. Troutman does not make any representations or warranties, expressed or implied, regarding the contents of this podcast. Information on previous case results does not guarantee a similar future result. Users of this podcast may save and use the podcast only for personal or other non-commercial educational purposes. No other use, including without limitation, reproduction, retransmission, or editing of this podcast may be made without the prior written permission of Troutman Pepper Lock. If you have any questions, please contact us at troutman.com.